Welcome to the fourth episode of the Balentine Road to Recovery. For prior episodes, please see balentine.com. Today, we'll be discussing buy, sell, or hold your closely held business in light of the unprecedented economic uncertainty and political uncertainty in our country. We are of the view that now is the right time to assess your options and bring together your trusted advisors to make a determination of what's the appropriate course of action based on your goals. My name is Mark Bell, and I'm the head of Family Office Services and Private Capital Investing at Balentine. At Balentine, we're focused on entrepreneurs in transition and have been having conversations with a number of our clients around this very issue. To that extent, we've brought together a panel of experts today to talk about the timing, the options, and what's entailed in buying, selling, or holding your business. From an investment banking perspective, we've asked Steve Tye to join us, who is a partner at Croft & Bender, where he heads the practice working with closely held family businesses in the lower middle and middle market. We've also asked Rett Peaden to join us from Smith Gambrell. Rett is a trusted advisor to a number of families as a corporate and M&A attorney. And then finally, we've asked Collins Brown to join us also from Smith Gambrell. Collins approaches closely held businesses and family decisions from a trust and estate perspective. We thank you for joining us for today's panel. And with that, we'll turn to the panelists to discuss buy, sell, or hold. Well, thank you all for being here again with us on the panel. To address the 800-pound gorilla in the room and on our minds, we have the prolonged pandemic and the impending election kind of looming over the deal environment. I'd love to start maybe, Steve, with you and your thoughts about how much the pandemic and the election as two contravailing forces have influenced valuations and deal activity.
Sure, and thanks for having me. We are seeing a rapid rebound in activity. Obviously, the second quarter was slow from a number of different angles and perspectives. I think from a deal flow perspective, it was its lowest level since 2014, Q2 of 2014. But what we've seen since then is a pretty rapid rebound, in particular for companies that had processes in motion prior to COVID. We've seen those companies proceed with deals, proceed with structures that were accommodative as the debt markets came back and settled back into place. Terms have changed a little bit, but for the most part, valuations have stayed intact. And so if you're looking at deal flow that's getting closed in the third quarter, valuations actually are back to pre-pandemic levels. And people are continuing to be pretty aggressive coming back out of this market to try to beat others to the punch, so to speak, and close transactions, while this window is open for us.
And Rett, what are you seeing on your end?
Yeah, I think very similar to that. During the beginning stages of the pandemic and going on a little while, we saw some deals that started to be retraded, and some of those were lower. But there have also been real pockets of strength in the economy. We've seen technology stay very strong. There are pockets in manufacturing that continue to not be adversely affected. So valuations have been really good in those areas. And we were recently looking at a deal with one of our clients that fell through about a year ago, and looking at some new offers. And basically some deal studies that we saw and some valuations maybe had come down a little bit at the top end, but on the lower half of deal valuations in the middle market, really no multiples have been coming down. And so we've stayed very strong in our valuation and what we expect to get in this deal.
Well, it's interesting, right? Because we read about or we talk about this K-shaped economy where some folks are really doing well and some folks are really doing poorly. When you average that out, maybe it looks flattish. it sounds like you're not seeing slippage in valuation on the transaction side. Is that just because it's only the upper part of the K that's able to come to market right now? And if it is a K-shaped recovery, wouldn't we see some increase in valuation for the digital survivors or the digital accelerants?
Yeah, I think that's exactly right. We actually are seeing an uptick in valuations overall. If you look at the data, we're at record highs from a multiple, and I think it is because the haves or the top part of the Ks are dominating the deal environment right now. I'd say as an anecdote, about 80% of our clients are actually performing. So the K is a little misshaped. When 80% of them are actually doing okay, and it's not just the digital focused companies. Obviously, you have those, and you have the acceleration of digital migration that hopefully is sustainable for a number of these companies. But you also have a lot of the essential services businesses. HVAC businesses are doing well. Water treatment businesses are doing well. Ones that you wouldn't think would be obvious beneficiaries here. Home remodeling obviously is a big trend. We've got some home distribution type businesses that are performing well. So it's really across a number of different industries. The ones that haven't been hit by the end markets of restaurant, hospitality, travel, for the most part are holding up pretty well.
And real quick, Steve, I mean, how can you tell, or how does a buyer tell if how much of that is true demand versus extended unemployment, government stimulus? If I'm purchasing a company, how do I feel good about the revenue and EBITDA being real?
That's a great question. I think a lot of the companies that were looking at buying companies had recession cases built into their 5-year models. What the question is now is, did we just see a recession case in Q1 and Q2? And if companies perform through that recession, quote unquote, are they now resistant to that, going forward? I don't think people know yet. I think that's a challenge to try to figure out. We've seen obviously starting to see a couple of COVID adjusted type of businesses where we are factoring in on a pro forma basis, had COVID not existed, what the business would look like. But I have talked to a number of private equity investors who have scratched their heads a little bit as to how do you value those that have actually benefited from COVID and the stay-at-home environment, and is how sustainable is that going forward? Is it an acceleration like on online retail where adoption has just accelerated by several years, or is it more of a temporary thing that ultimately will go away? I think one of the challenges is that nobody knows what the next 2 to 3 years are going to look like. Nobody knows what the stay-at-home environment is going to look like. So, those are some of the challenges that people have to figure out.
From a transaction standpoint, Rhett, any thoughts on that from your end, or?
Yeah, Mark, I think we have started to see a lot of shift, in the terms of the deals that are being negotiated and what's out there. Maybe more so that's showing up than in the valuations. And what do some of those look like in negotiating term sheets, which that's really some of the first places you're seeing that flow through to. We were coming off a very seller friendly environment, and you would see extensive term sheets where a lot of the positions are already negotiated out ahead of time, because really a seller has maximum leverage in a deal at the very beginning, at the term sheet stage, and they lose that progressively as the deal goes forward. So now what you're seeing is much more short term sheets, very high level and general, and that leaves a lot of room for the buyer through the due diligence process to adjust the deal as they see fit. So that's the first place we're starting to see a trickle through in the deal terms. There are some things that just pre-COVID don't work the same in this environment. One of the very heavily negotiated provision in many deals is a material adverse effect clause, and that's a way that a buyer, between the time you sign the deal and you close, it allows them an out if something adverse happens. And so, one of the things that is starting to be negotiated is should the pandemic, should that be carved out of the material adverse change definition, because we all know about it. It's not like it's a surprise that's going to happen between signing and closing. And so obviously a seller would like to exclude that as a factor that gives the buyer an out. Buyers, are not going to want to agree to that. And with the leverage they have, you may come up with some compromise language that the pandemic doesn't affect this company more adversely than any other peer in its industry, or some other compromises. You've got issues that are starting to creep up now a lot with the treatment of the PPP loans.
Mm-hmm.
And that is something that traditionally, that's a general unsecured obligation of the company. That would be treated as part of indebtedness and to be paid off at closing. But now that that everyone believes that most of those loans will be forgiven, it really isn't apt to make a purchase price adjustment at closing on those loans. But how do you deal with it if it's not forgiven? There's still a lot of uncertainty and revisionist history about what those loans are and what they were meant to be, and how they should be treated going forward. Who has the authority to forgive the loan? And you've got the audit process, which a lot of companies will be audited on those loans. That may not happen in the 90-day period in which an initial decision should be made on forgiveness. So there's a lot of uncertainty surrounding the treatment of those loans. And then just, getting due diligence done. In the past, you may have some physical meetings. You may have people going out to the site, a lot of handshakes between the parties to get the deal done, sending out accountants and bankers to kick the tires, check the inventories as you go into closing. And a lot of that is just, getting the deal done like that has started to change. Technology has been very important in making that shift. And a lot of what we did was already done remotely and virtually. So that's been easier on our side as attorneys. But for a lot of the other professionals that are involved in getting the deal done, it's harder when you're not sitting right across the table from someone and kind of get the sense of the people and how things are coming across. So there definitely been some changes in the process and in the deal terms that have shown up.
But it sounds like for the right company, deals are absolutely still happening, and maybe even happening at slightly better valuations. I guess, Collins, turning to you, the multi-million-dollar question is, the possibility or the potential for estate tax or tax reform, and how closely held business owners should think about weighing those risks. What kind of conversations are you having with clients with closely held businesses?
Yeah. Lots of conversations about that topic. I will say quickly on the valuation issue from an estate planning perspective, I think the K that you talked about, Mark, is really helpful. That uncertainty, the fact that there's still some sectors in the economy that are really struggling. I think that helps our valuation on the estate planning side when we're trying to keep those values down, especially when we're doing like a DCF, where the valuation is based off of projections and there's just a lot of uncertainty. With respect to the tax issues, so much. I mean, you talk about uncertainty, so much uncertainty. Who's going to win the election? Who's going to be the president? Which party is going to control the Senate and the House? A lot of uncertainty. One thing we do expect is that if Democrats control the presidency and both houses of Congress, that there will be a tax bill. Whether that's immediately or later in the year, we would expect some tax legislation to get passed. And so, we need to pay attention to Biden's plan. From my perspective, the two big issues for business owners are a potential change in capital gains rates. So Biden has proposed eliminating preferential capital gains treatment, preferential rates for certain taxpayers. I think the number is if you're over $1 million of taxable income. So for M&A transactions, that could be a huge deal, right? If you're talking about after-tax income being cut potentially in half, or something close to that. And so I think that's a huge impetus for people to try to get deals done this year if they can. There's certainly nothing preventing Congress from passing a law in the middle of the year that would be retroactive to the start of the year, unfortunately. Mm-hmm. The second tax issue is on estate planning. Right now, an individual can leave $11.58 million to his or her heirs free of estate tax. For a couple, that's over $23 million. That's a huge number. And it really doesn't affect that many taxpayers. Of course, I think the people that, a lot of people that are thinking about selling their business fall into that category. Mm-hmm. But it's not something that ordinary folks are having to think about. We think Biden would potentially cut that to $5 million index for inflation, so maybe somewhere around 6, basically cut it in half. A lot of people have said we have to pay attention to Bernie Sanders' plan, which was to cut that number to $3.5 million. So it would be $7 million of exemption for a couple. And so I think to try to get that kind of planning done to move assets out of your state by the end of the year, depending on what happens in November, it is going to be a choice that a lot of people have to make. And so at a minimum, I think we're seeing clients just gather their trusted advisors and say, what do we need to do? What do we need to be thinking about? Maybe we do nothing. Maybe we get some stuff teed up so that we can pull the trigger at the end of the year if we need to on estate planning. A little bit harder to do that on an M&A deal. But maybe we'll get some stuff teed up where we can just pull the trigger in December if we feel like that's a wise thing to do.
And is it possible, guys, to get a deal done between now and the end of the year, between now and, January 20th or whenever the swearing in is of a new president?
From our perspective, I'd say absolutely, although, you're certainly running out of time. We have a couple of clients that have reached out to us to start processes. I think processes look a little bit different from a number of different angles. First, the magnitude of the process. We're seeing a number of clients either shorten the number of parties that we reach out to just from a time standpoint. Some of which, you may go to a few dozen parties. You may go to 5 parties and see what they think this year. And if you can get a deal done this year, great. If you can't, then you go to a broader group next year. But absolutely, sitting here in mid-September, if you're interested in doing something before the end of the calendar year, you need to start to get your house in order and really go to market. That reach out can obviously occur before you're ready to go to market, and so the buyers can be ready. But I'd say the buyer universe is ready to act as well. We've seen a lot of great response from buyers in our processes that we've launched. Our sense in the marketplace is that there are a number of processes that did launch around Labor Day, and so people are looking at deals. They want to be selective. If they know they're part of a limited group, they're going to pay more attention to it. And so from our standpoint, we feel like you can still run a very effective process and drive valuation and optimize it for the client. But you certainly have to start it, with the amount of time that it's going to take to diligence and to close the transaction. It's time to get going.
So I'm an entrepreneur. I have a closely held business, and I'm concerned about some of the things that Collins mentioned. What do I need? What do I need to have to come and sit down with you guys and get ready to do a process? Where do I need to be?
From an organizational standpoint, well, to Colin's point, you need to get your trusted advisors around you. And part of that is understanding, obviously, the legal history of your business and starting to prepare and gather all your legal documents, understanding, estate tax planning from Colin's perspective, and then from an accounting perspective. Obviously, any buyer is going to want to look at clean financials that are either audited, have quality of earnings have been performed, or they have enough faith that the numbers are prepared in a GAAP accrual-based format. Those are typically the longest lead times from an organizational back office perspective. And then it takes about 4 weeks, I'd say, to to pull all the materials together, all the marketing materials, make sure you build the right financial model to show to buyers, and that you're telling the right cohesive story to be able to maximize valuation before you go to market.
Yeah, I think there's definitely the professional that's not here on the panel today is the accountant. And I think having a good financial advisor is key to putting together that team. And I think getting a good M&A lawyer involved early in the process is helpful, because we can really add more value on the front end than we can as things progress. And I think Collins would probably echo that from a T&E standpoint. The longer you have to let things percolate and to do the planning ahead of time, the better result you're going to see. That said, we are getting on a tight timeline to get something done before any changes come down the pike. I think the key dates to be aware of, not necessarily January 1st, but there's a question of once a new presidency and a new Congress, whatever that looks like, is in place, it's going to take a while for the legislation to pass through, and whether or not it's going to be retroactive to January 1, whether that's possible, it's an open question. So, what type of changes we'd be looking at from a tax standpoint, I think from a regulatory standpoint, and from a trade standpoint, those are all things that we are closely monitoring, seeing what the proposals are coming out, being floated right now. I think there have been talks about changes in the carried interest tax rules, which those certainly could have a chilling impact on private equity investors if it makes it harder for them to get a long-term capital gains treatment on their investments. I think from a regulatory standpoint, we think it may be somewhat of a mixed bag. There are some healthcare regulations that may actually drive funds into the healthcare sector, but there are a lot of environmental regulatory changes that have been mentioned that could put a tamp down on some of the manufacturing sector. And then from a trade standpoint, I think there's been a fundamental shift in the international balance of trade, but we would, depending if Biden is elected, we might expect a little bit of a unfreezing of the trade war, and maybe some relief for some clients who play in that space. So it could be very much a mixed bag, but the timeline on when those changes might take place is still uncertain, no matter what we wake up on November 4th and realize what the new government is going to look like.
Collins, any thoughts on your end around timeline or dates like Rhett was talking about? I assume it's roughly similar.
Yeah, I think that's right. I mean, the sooner the better. We expect, if there's a Democratic sweep, we expect to be really, really busy in November and December. And valuation experts are going to be really busy. CPAs are going to be really busy. And so, I think the earlier the better. Like I said, there's stuff that we can do now to prepare for that. That's not a massive undertaking where, we're sort of just hitting the go button, maybe in December. And to what Rhett and Steve mentioned, I think, gathering everybody together is great. The trusted advisors. I think somebody like you guys, Mark, are really well suited to lead that conversation. So obviously, M&A lawyers, investment bankers, trust estate lawyers need to be a part of the conversation. CPA needs to be a part of the conversation. But we're all just looking at one little slice of the pie. And so I think for a financial advisor to be leading that process, to say, is there anything we need to do before the end of the year or early next year? I think somebody like y'all is really well suited to gather everybody who's involved and make a decision.
And I think I would echo that comment, and because there's a lot of economic decisions to be made here for somebody. I mean, if you're looking at a change in tax rate, capital gains from what is 23.8 to 43.4, then if you sell a business for $100 million today, you'd have to sell it for $135 million next year if those rates go through. And so you have to look at that. You have to look at after-tax proceeds, and then what you're going to do with those after-tax proceeds to see, how you're going to manage your wealth going forward, for sure.
One of the things we're seeing, and I don't know if you guys see it in your practices, folks have had tremendous growth in their business, say over the last 3 years, maybe to their surprise and delight. They'd like to continue to run the business. They see a lot of opportunity ahead. They might be frustrated that the pandemic slowed their growth plans. Debt is incredibly cheap. Let's kind of do a recap on our business. Maybe let's even borrow and buy, a smaller competitor who maybe is on the bottom part of that K. How has the low rate environment and the debt environment affected kind of the clients you work with and the stuff you guys can take on and advise on?
Well, from our perspective, I guess coming out of the quarantine, the debt markets were the one thing that had to settle down first, right?
Mm-hmm.
That was the first one that the pendulum swung so far to the other side that it was tough to get deals done in April and May that had debt components to it. Now we've seen them settle back down, and pricing is somewhere, depending on obviously the business, 100, 150 basis points, probably more expensive. You can borrow probably a turn less than you were before. Most of the businesses we work with are more growth oriented, so don't rely as much on that leverage to finance transactions, but it's real. But at the same time, you look at it, and as you mentioned, that we've coming off of record economic growth, record valuations. By historical standards, the leverage levels and the pricing is still very, very attractive.
Mm-hmm.
So whether it's a debt recap, as you mentioned, or even we've seen a number of parties look at equity recaps. Businesses that have grown rapidly over the past 3 to 5 years, founders have generated a lot of wealth. They want to continue to do it, but they want to de-risk themselves somewhat. And so we've seen a major willingness for private equity firms to buy minority stakes and look at minority recaps of these companies, which founders, usually don't think as much about. They think more about the majority transaction. They're giving away the business. If they can do a transaction where they maintain economic control, bring on a new partner that can help them in areas that they need help, and also de-risk themselves from a financial perspective, it's a very attractive alternative for them.
Yeah. And, coming into this, we were talking about this idea of buy, sell, or hold. That gets into the hold idea a little bit. But,
yeah.
I think, from a planning perspective, it doesn't always have to be either or. There's a whole suite of options that if you sit down with your advisors, you can tease those out. And part of it may be bringing in an outside investor, even if it's not you're not selling the company in its entirety. Part of it may be you retain some control, but you do a recap process and you get some of the equity down to the next generation. So there's a whole suite of options that you can look from. And I was just looking back earlier in the year. I gave kind of a M&A preview talk. And one of the interesting things is we looked at several circling black swans. Not one of them was the coronavirus, but it just goes to show you, you never know what's going out there in the market. But one of the studies that I left off with at the end of that preview was a study by Boston Consulting Group, where they had looked at 57,000 deals. And companies that had done deals and acquired other businesses in a downturn had significantly higher returns than companies that were buying at the top of the market. So if you've got the wherewithal to be doing deals right now, I think from a long-term standpoint, now might be the time to really to lock in some of those gains when you buy a company, rather than waiting for valuations to get higher and for the economy hitting on all cylinders. You're less likely to find a good deal.
Makes a lot of sense. Collins, from your end, are there options from an estate or tax perspective that minority, either equity or recap, give you? I mean, we obviously have folks who are trying on the one hand to hire Steve and get the highest price for the company, and might also say, well, maybe it's time to do some estate planning, and I want a very low valuation for the company as well. And if I go through a process, does that peg my value somehow? What flexibilities or creativity are you seeing there?
Yeah, great question. And I think those two can certainly go hand in hand, doing sophisticated estate planning and going through a process with somebody like Steve, where you're trying to identify a buyer. The earlier we do that, the better. I mean, it's not a great look to have a super low valuation that we're giving to the IRS, followed shortly by a massive sale where the numbers are dramatically different. Even though it can be defensible, especially depending on what you transfer, what assets you actually transfer. And so certainly nothing that would prevent you from running that side by side. I do think the low interest rate environment makes this just such a unique time to do estate planning. I mean, you've got, like we talked about, these exemptions are at an all-time high. Interest rates are at crazy low numbers. So the IRS publishes sort of minimum interest rates that we need to use and other factors that we use in transferring assets. And they're just laughably low right now. And so to be able to move assets almost for free, I mean, not quite, but almost for free using installment sales or gifts. And we've got all this, like I was talking about before, all this uncertainty out in the market that's affecting valuations. There's just never been a time like this to try to move assets for estate planning purposes.
So it kind of, to summarize what I hear from the panel, is assemble your advisors. It's not too late to act, but it's certainly getting close. If you do decide you want to do a sale that is deemed this year, and I think Steve made a very interesting point that if you can't get your price this year and you've organized yourself, that doesn't prevent you from going back out next year. You need to think seriously about the opportunity to transfer, gift, or move assets potentially from an estate. What kind of, given the uncertainty, election alone, pandemic, civil unrest, and I'm sure we'll have one or two more black swans, as Rhett said, to add in before we get through with 2020. What's kind of your parting advice that you would give to that entrepreneur, business owner that owns a small business that's thinking, or small to medium business that's thinking buy, hold, or sell right now? Collins, maybe you can kick off our final thoughts.
Sure. I think these things that we're talking about right now are kind of specific to 2020, but they're applicable. They're going to be applicable over the next few years, even if some of these things that we think might happen with respect to the election don't actually happen. I mean, at some point, taxes are going to have to go up. At a minimum, some of this is set to sunset at the end of 2025. And so I think to have a good team in place, to have a good plan for the next few years, if not for the next couple of months, is essential. So the principles are going to stay the same.
Mm-hmm. Mm-hmm.
Yeah, and I'd add to that, to the point of assemble your team and look at your alternatives. You know, there's a lot of analysis that goes into this. There are a lot of different alternatives to evaluate here. The other thing I'd say is that buyers are out there. Buyers, one thing we haven't talked about is that a lot of buyers have been sitting on cash for 6 months and are ready to deploy it. And so they'll get creative with structure. They'll get creative with what type of recap might look like, and they'll move quickly if it's the right situation for them. So, but back to the point, I think getting together with your advisors and starting to look at your alternatives and what actually is feasible, and what valuations it might be feasible, is appropriate.
Yeah, I think, when I did this M&A preview at the beginning of the year, one of the figures that was thrown out there is that there's $4 trillion of dry capital on the sidelines among several sources, predominantly private equity and strategic buyers, oftentimes with a mandate to go out there and get deals done. So I think there's a good demand side out there. And on the supply side, I've been having for years conversations with my baby boomer business owner clients about, what, we need to make decisions about what to do. Do you really want to manage through another crisis like 2001 or 2007 and 8?
Mm-hmm.
And here we are, in the third time in 2 decades with a major disruption. So a lot of those clients now have really started to come around and have those serious discussions, whether it's, COVID, the election, looking at their own mortality, Many of them in the baby boomer generation have held on to businesses longer because they're younger 70-year-olds than people in the past were. But at this point in time, now they're getting very serious about those conversations that I couldn't interest them in 2, 3, 4 years ago. So I think if you find yourself thinking about those questions, wanting to sit down with advisors and talk about it, you're not alone. All your compatriots are having similar thoughts. So I think it's time really to take some action and talk it through and see what solutions would work best for you.
Well, gentlemen, thank you. I appreciate it. I think when you think about buy, hold, or sell, I think that the consensus here is the answer is it depends. And it depends on a whole constellation of factors around your business and really around the broader picture of your life and your goals and what you're trying to achieve and do. And so I appreciate y'all's thoughtfulness. I'm sure we will all be busy from now until the end of the year, regardless of election and the course of the pandemic. But appreciate y'all's time today and your insights.
Thanks for having us.
Thanks, Mark.
Thank you for joining our panel discussion today. Please find this panel and other information available on Balentine.com, where our website offers many resources for entrepreneurs in transition. Also, look for our forthcoming book from our CEO and chairman, First Generation Wealth, focused on entrepreneurs in transition. More information is available at www.firstgenerationwealth.com. And thank you.